Most people sign a mortgage without fully understanding what they just agreed to. And I don't mean that as a criticism, I mean it literally. I spent 12 years in banking as a teller, a personal banker, a branch manager, and a mortgage loan originator, and I watched it happen constantly. Good, smart people sitting across the desk from me, nodding along, signing page after page, because nobody had ever taken the time to explain it in plain language. That's what this channel is here to fix. In this video, I'm going to tell you exactly what a mortgage is. Not the textbook definition, but the honest explanation. What you're actually agreeing to, how the money moves, why it's structured the way it is, and what that means for you over the life of the loan. No jargon, no sales pitch, just the information you should have had before you ever walked into a lender's office. Let's get into it. Here's the simple definition of a mortgage. A mortgage is a loan used to purchase real estate. You borrow money from a lender, usually a bank, credit union, or mortgage company. You use that money to buy a home, and then you pay it back over time with interest. Simple enough, but the definition leaves out the most important part. A mortgage isn't just a loan, it's a secured loan. That means the home itself is collateral. If you stop making payments, the lender has the legal right to take the property back through a process called foreclosure. That's the part that changes everything. When you take out a mortgage, you're not just borrowing money, you're pledging your home as the guarantee that you'll pay it back. Understanding that one fact will help everything else in this video make sense. When you close on a home, you sign a lot of paperwork, but at the core of it all are two documents. The first one is the promissory note. This is your personal promise to repay the loan. It spells out the loan amount, the interest rate, the monthly payment, and what happens if you default. This document is about you, your obligation to the lender. The next is the deed of trust, or mortgage document. This is the document that ties the loan to the property. It gives the lender a legal claim, called a lien, on your home. If you stop paying, this is the document that gives them the right to foreclose. Here's why this matters in practice. Until your loan is paid off in full, you don't own your home free and clear. You own it subject to that lien. The lender has a legal interest in the property until the debt is gone. That's not a bad thing, it's just the honest truth about how home ownership works when financing is involved. Now, let's talk about where your monthly payment actually goes. This is the part that surprises most borrowers. When you make a mortgage payment, it's split between two things, principal and interest. Principal is the portion that reduces what you owe. Interest is the cost of borrowing. It's how the lender makes money. Here's what most people don't realize. Those two amounts are not equal across the life of the loan. They shift over time. In the early years of your mortgage, the majority of your payment goes towards interest. On a $300,000 loan at a 7% interest rate, your first payment might actually be around $2,000. Of that, roughly $1,750 goes towards interest, and only about $250 actually reduces your loan balance. By the time you're near the end of the loan, that flips. Most of your payment is going toward principal. This structure is called amortization. It's designed so the lender collects its interest cost up front when the risk is the highest and the balance is the largest. It's not a conspiracy, it's just math, but you should understand it because it affects decisions like when does it make sense to refinance, how much does an extra payment actually save you, and why does paying off a mortgage early save so much interest. Here's something else that catches first-time buyers off guard. Your mortgage payment is usually more than just principal and interest. Lenders typically require what's called an escrow account, a holding account they manage on your behalf. Each month, a portion of your payment goes into that escrow account, and the lender uses it to pay your property taxes and homeowner's insurance when they become due. This four-part payment, principal, interest, taxes, and insurance, is often referred to as PITI. If you put down less than 20%, you'll likely also have private mortgage insurance, or PMI, added to that payment. PMI protects the lender, not you, in case you default. It typically ranges from 0.5% to 1.5% of your loan amount annually. The takeaway here: when a lender tells you what you qualify for, make sure you understand whether that number includes taxes, insurance, and PMI, or just the loan payment itself. Those additional costs can add hundreds of dollars per month to what you actually owe. The last concept I want to cover today is the difference between a fixed rate and an adjustable rate mortgage. A fixed rate mortgage keeps the same interest rate for the entire life of the loan. 15 years, 30 years, whatever term you choose. Your principal and interest payment never changes. Predictability is the main advantage. An adjustable rate mortgage, or ARM, starts with a fixed rate for an initial period, often 5, 7, or 10 years, and then adjusts periodically based on market conditions. The initial rate is usually lower than a fixed rate, which is why it can look attractive. The trade-off is risk. If rates go up after your initial period ends, your payment can increase, sometimes significantly. ARMs have caps that limit how much the rate can change at each adjustment and over the life of the loan, but you're still taking on uncertainty that a fixed rate eliminates. For most buyers, a fixed rate mortgage is the simpler, safer choice, especially in a market where rates could move in either direction. But that's a conversation worth having with a loan officer who can run the actual numbers for your situation. So let's bring it all together. A mortgage is a secured loan backed by the home itself. You sign two core documents, one that represents your personal promise to repay, and one that gives the lender a legal claim on the property. Your payment is split between principal and interest through a process called amortization, which means interest is weighted toward the beginning of the loan. Your total monthly payment typically includes taxes and insurance and escrow, and possibly PMI, and your rate will either be fixed for the life of the loan or adjustable after an initial period. That's not everything there is to know about mortgages, but it is the foundation, and most people never get a clear explanation of this before they sign. In the next video on this channel, we're going to talk about mortgage pre-approval, what it actually means, how lenders decide what you qualify for, and why getting pre-approved before you shop for a home is one of the most important steps you can take. If this video is useful to you, subscribe. Every video in this channel is built around one goal, giving you the information you need to make smart decisions without the sales pressure. There's a lot to understand before you buy a home, so let's go through it together.